In this video, we will talk about Rivian. Before the video begins, if you like my content, please consider to like, comment and subscribe to my channel for more. Rivian is a significant player within the electric vehicle sector and has garnered significant attention from investors. We're going to look at crucial financial indicators to evaluate the suitability of Rivian stock as a potential candidate for acquisition, retention or divestment. The company is currently experiencing robust revenue growth, mostly driven by increasing vehicle sales and successful production expansion efforts. These new developments show substantial growth potential in the foreseeable future. On the other hand, Rivian has been, and still is struggling with a negative operating profit margin of 210%. The company is incurring substantial losses, a situation that will persist until it reaches the necessary scale for profitability. Doing so requires a lot of capital injections, either from taking on debt, or by diluting the existing shareholders. In 2023, Rivian's plan to manufacture 52,000 electric vehicles falls short of the volume required to achieve profitability. A substantial boost in production is a must, and there is still hope in the potential benefits of economies of scale to be realized in the short term. As sales rise, Rivian's operating profit margin, although still in the negative territory, also shows signs of improvement. This is an encouraging signal for long-term investors and underscores the importance of reaching higher production volumes. Rivian's substantial investments in manufacturing capacity and research and development have resulted in negative free cash flow, which recently stood at a deficit of $6.8 billion. The possibility of achieving positive free cash flow remains distant, given the company's expansion plans and ongoing investments. The company's reliance on borrowing is evident, with $2.71 billion in long-term debt. Furthermore, Rivian has significantly increased its share count, rising from 720 million shares in July 2021 to 942 million in September 2023. This illustrates the company's dependence on debt and share issuance to finance its operations. In the current circumstances, Rivian stock appears to be in a hold position. It is not an immediate buy, due to lingering uncertainties surrounding profitability and free cash flow. While it is not excessively overvalued, it lacks the stability necessary to warrant a strong recommendation for purchase. Overall, the future prospects for Rivian hinge on the successful execution of ambitious milestones and the achievement of gross profit margins surpassing 20%. However, the company's substantial capital requirements and ongoing investments raise concerns about its long-term financial viability. There have been 24 million shares traded, compared to 30-day average volume of 22 million shares. In terms of the medium-term volatility, its share price fluctuated between $11.68 and $40.86 on a year-to-year basis. The traded share volume provides us useful information into market activity. It reveals the quantity of shares exchanged at a specific moment, thereby indicating the adequacy of liquidity to facilitate trading strategies. A low volume float can make the stock price susceptible to manipulation and also suggests that the demand can be low. Comparing prevailing volume to the historical average can also show us potential for trend reversal or breakthrough when a substantial difference exists. For instance, a stock breaking through would very often have much higher current volume compared to its historical average. The market cap of Rivian is currently at $22 billion, compared to an enterprise value of $15 million in its enterprise value. The quick comparison between the market cap and the enterprise value often gives us an idea of whether the stock is trading at a premium or a discount compared to its intrinsic value. It is far from being a perfect measure, but it does offer us an idea of what the current momentum might be. A market cap that is higher than the enterprise value suggests that the stock is trading at a premium, probably because the market believes that the company can deliver in its promises in the future. On the other hand, if the enterprise value is higher than the market cap, then it is a sign that the company may have significant fundamental weaknesses or even solvency issues. When we look at the options market, the ratio between put and call options is 54%. 53,000 contracts have been traded within the most recent day, and over the past 30 days there have been 93,000 contracts traded. The options contracts can help traders to both hedge their risks and provide an additional revenue stream by selling them to others. The put options allows shares to be sold at a strike price, and the call options allow purchases at the strike price. They can be traded until the expiration date, and can tell us what the market sentiment is towards a company, although they might sometimes be wrong. When we look at the ownership structure of the company, 69% of its outstanding shares are owned by the institutional shareholders, some of the biggest institutional owners being Vanguard, BlackRock, and Amazon. Typically, we would prefer to see institutional involvement if we decided to hold a stock for the long haul. This adds a level of stability and reassurance in the medium to long term. It indicates that the market believes the stock will provide value over an extended period, a crucial aspect for investors to weigh. In my view, a reasonable benchmark for institutional ownership would be in the range of 25% to 30%. However, it's worth noting that there are exceptions to this guideline, as some outstanding companies are predominantly owned by individual retail traders. Additionally, not all stocks are purposed for long-term investing either, making some equities worthwhile to be bought even if they have weak fundamentals and low institutional participation. Lastly, let's take a look at the short interest of Rivian. According to Fintel, the short positions take around 13% of the total floats, and 51% of the short transactions are made in the dark pools. Short interest is important in stock markets. It measures how many shares of a company are borrowed and sold by investors who bet the stock price will fall. When enough people do this collectively, the measure becomes a hot topic. Short squeezes happen when the stock price rises unexpectedly. Those who borrowed shares must buy them back at higher prices, causing more buying, raising the price even more. The theory is that this would force short sellers' hands and bring large profits to the long positions. Short squeezes aren't common. They need high short interest, which isn't always present. Market conditions, company news, or social media can trigger them. Some stocks also have protective mechanisms, like circuit breakers. Timing short squeezes is hard. Investors may lose a lot if they put their money on the wrong stock or at the wrong time. Risk and uncertainty are always there. Short interest shows the number of positions people believe that the stock will tank. Short squeezes do occur but aren't usual. They have been the exceptions to the rule, and not the other way around. Predicting them can be tricky, as retail traders are often too optimistic in calling them. Rivian can be a speculative investment position with substantial potential rewards if it effectively implements its plans. However, the corresponding risks are significant, and the company's path to profitability remains uncertain. Investors should closely monitor Rivian's progress and financial health before making a definitive buy decision. For the moment, the company has been able to increase its baseline, and may see some pullbacks in the following months. This is why I would personally recommend not to buy more shares for the time being, and to wait for a few weeks to see where the stock wants to go next.